Question 1. Legal and regulatory framework. What is the primary purpose of the feasibility study required for forming a captive insurance company in Maine? A. To determine the potential profitability of the captive for its owners. B. To assess whether the proposed captive structure meets regulatory compliance standards. C. To evaluate whether the risks intended for coverage can be effectively managed by the captive. D. To analyze the potential tax benefits of the captive insurance arrangement. Answer: C. To evaluate whether the risks intended for coverage can be effectively managed by the captive. Explanation: a feasibility study is a critical part of forming a captive insurance company as outlined under Title 24A of the Maine Insurance Code. Its purpose is to evaluate the ability of the captive to manage the intended risks effectively. This includes analyzing risk retention levels, premium adequacy, and financial solvency. While regulatory compliance, profitability, and tax considerations are essential, these are secondary to the core purpose of risk assessment. Regulators require a well-documented feasibility study to ensure the captive is viable and sustainable under anticipated conditions. Question 2. Scenario-based question: captive operations and governance scenario. Jane Smith, the CFO of a manufacturing company, oversees their single-parent captive domiciled in Maine. Recently, the captive board voted to outsource its claims management to an external service provider. However, the new claims manager proposed a policy change that could reduce claim handling times but introduces potential compliance risks. What should Jane prioritize in this situation? A. Approving the policy change immediately to enhance efficiency. B. Conducting a thorough compliance review of the proposed policy change. C. Deferring the decision to the captive manager to avoid personal liability. D. Seeking legal counsel to draft a disclaimer absolving the captive of compliance risks. Answer: B. Conducting a thorough compliance review of the proposed policy change. Explanation: captive operations and governance require adherence to regulatory standards and risk management best practices. Jane must ensure that any policy changes align with Maine's insurance laws and do not jeopardize the captive's compliance. Conducting a compliance review reflects proper governance practices and ensures the board fulfills its fiduciary responsibilities. Approving changes without review could expose the captive to legal and financial penalties under Maine law. Delegating or disclaiming responsibility is inappropriate as it undermines the governance framework outlined in the captive's operational charter. Question 3. Reinsurance and captives. Which of the following best describes the role of reinsurance in captive insurance operations? A. Reinsurance eliminates all risks retained by the captive. B. Reinsurance allows captives to share risks with external insurers, enhancing financial stability. C. Reinsurance is exclusively used for compliance with Maine's capitalization requirements. D. Reinsurance guarantees a profit for the captive regardless of claims experience. Answer: B. Reinsurance allows captives to share risks with external insurers, enhancing financial stability. Explanation: reinsurance is a critical tool for captives to transfer portions of their risks to external insurers. This helps maintain financial stability, particularly for large or unpredictable losses. Maine regulations permit captives to leverage reinsurance arrangements to manage their solvency and exposure effectively. Reinsurance does not eliminate all risks, but reduces the captive's net retention. It is not solely tied to capitalization requirements, nor does it guarantee profitability, as claims experience can still impact the captive's financial outcomes. Understanding reinsurance contracts is vital for ensuring the captive's operational sustainability. Question 4. Taxation and captive insurance. Which of the following scenarios would most likely meet the IRS requirements for risk distribution in a captive insurance arrangement? A. A single-parent captive insuring only the risks of its parent company. B. A group captive insuring the risks of 5 unrelated businesses operating in different industries. C. A single-parent captive reinsuring 90% of its policies through an offshore reinsurer. D. A protected cell captive insuring only the risks of its cell owners within a single industry. Answer: B. A group captive insuring the risks of 5 unrelated businesses operating in different industries. Explanation: the IRS requires captives to demonstrate sufficient risk distribution to qualify as true insurance entities. This generally involves insuring risks across multiple entities or risk pools. Group captives with unrelated businesses typically satisfy these requirements, as risks are spread among independent parties. Single-parent captives insuring only their parent company's risks lack the necessary risk distribution. Reinsurance arrangements or protected cells may not inherently fulfill the IRS criteria if risk distribution remains within a narrow scope. Question 5. Financial management of captives. A captive's investment strategy is constrained by regulatory requirements. Which of the following is an appropriate investment decision for a captive domiciled in Maine? A. Investing in speculative derivatives to maximize short-term gains. B. Allocating funds solely to high-risk equity portfolios to increase returns. C. Maintaining a diversified portfolio with a focus on preserving capital. D. Using captive funds to directly finance unrelated business ventures of the parent company. Answer: C. Maintaining a diversified portfolio with a focus on preserving capital. Explanation: Maine regulations require captives to adhere to prudent investment principles to ensure solvency and liquidity. Captives must prioritize capital preservation and avoid excessive risk. Speculative derivatives or high-risk equities could jeopardize the captive's ability to meet policyholder obligations. Similarly, using funds for unrelated ventures would conflict with the captive's primary purpose and potentially violate Maine's regulatory standards under Title 24A. Question 6. Scenario-based question. Risk management principles. Michael Brown, a risk manager for a large corporation, is evaluating whether to transfer cyber liability risks to their captive insurance program. The proposed policy would cover third-party liabilities, breach response costs, and regulatory fines. However, the captive's historical loss data primarily includes workers' compensation and property risks. What should Michael consider before adding cyber liability coverage? A. The captive's historical claims experience and its ability to handle unfamiliar risks. B. The feasibility of reinsuring all cyber risks with a fronting insurer. C. The potential tax advantages of insuring cyber risks within the captive. D. The ease of adding cyber liability coverage without regulatory approval. Answer A. The captive's historical claims experience and its ability to handle unfamiliar risks. Explanation: Adding a new line of coverage like cyber liability requires evaluating the captive's capacity to manage unfamiliar risks effectively. Michael must consider whether the captive has the expertise, reinsurance arrangements, and financial capacity to handle potential losses. While reinsurance can mitigate some risks, it does not replace the need for the captive to have a sound risk management strategy. Regulatory approval may also be required, but the decision should prioritize operational feasibility and risk alignment. Question 7. Insurance coverage and policies. Which type of coverage is most commonly offered by captives and typically the easiest to underwrite? A. Professional liability insurance. B. General liability insurance. C. Directors and officers' dear liability insurance. D. Cyber liability insurance. Answer: B. General liability insurance. Explanation: General liability insurance is one of the most common coverages offered by captives because it involves predictable risks and established underwriting practices. Professional liability and DO insurance are more complex due to their long-tail exposures and potential for large claims. Cyber liability, though increasingly popular, presents challenges due to its evolving risk landscape and lack of extensive historical data. Main captives often begin with general liability before expanding into more specialized lines. Question 8. Captive operations and governance. Which of the following is a key responsibility of a captive's board of directors? A. Setting premium rates for all policies. B. Ensuring the captive adheres to regulatory and compliance requirements. C. Conducting daily claims management activities. D. Directly underwriting all risks. Answer: B. Ensuring the captive adheres to regulatory and compliance requirements. Explanation: The board of directors of a captive plays a governance role, ensuring the organization complies with Maine's insurance laws and operates effectively. They are responsible for oversight rather than day-to-day activities like claims management or underwriting. Premium rates and underwriting are typically the responsibility of actuaries and underwriting teams. Adherence to compliance and regulatory standards is critical to avoiding penalties and maintaining the captive's license. Question 9. Reinsurance and captives. What is the primary benefit of proportional reinsurance for a captive? A. It allows the captive to transfer all risk to the reinsurer. B. It provides financial stability by sharing premiums and losses proportionally. C. It eliminates the need for actuarial pricing of policies. D. It ensures compliance with Maine's minimum capital requirements. Answer: B. It provides financial stability by sharing premiums and losses proportionally. Explanation: proportional reinsurance involves the reinsurer sharing both premiums and losses with the captive, which enhances financial stability and risk management. It does not transfer all risks as the captive retains a portion of the liability. Actuarial pricing remains essential to determine adequate premiums. While proportional reinsurance supports solvency, it is not a direct compliance mechanism for capital requirements under Maine law. Question 10. Emerging trends in captive insurance. Which of the following best demonstrates the use of captives in managing ESG, environmental, social, governance risks? A. A captive insuring a parent company's general liability risks. B. A captive funding initiatives for renewable energy projects. C. A captive reinsuring risks related to offshore operations. D. A captive managing claims for employee benefits programs. Answer: B. A captive funding initiatives for renewable energy projects. Explanation: captives are increasingly utilized for escalated objectives, such as ensuring renewable energy projects or funding sustainability initiatives. This aligns with the parent company's broader ESG goals. General liability risks and employee benefits, while important, do not specifically address ESG priorities. Reinsuring offshore risks also falls outside the typical ESG framework. Maine captives are encouraged to explore innovative applications to support environmental and social objectives. Question 11. Legal and regulatory framework. Under Maine's captive insurance regulations, which of the following is required as part of the licensing process for a new captive? A. Submission of a feasibility study including actuarial analysis. B. Certification of policyholder guarantees by the parent company. C. Proof of operational history of at least 5 years. D. Immediate contribution to the Maine Captive Guarantee Fund. Answer: A. Submission of a feasibility study including actuarial analysis. Explanation: Maine's regulations mandate a feasibility study to ensure the captive's financial viability and capacity to manage risks. The study typically includes actuarial analysis, business plans, and proposed coverages. Operational history is not required for new captives. There is no Maine Captive Guarantee Fund. Policyholder guarantees are not a general licensing requirement but may arise in specific contexts. Question 12. Risk management principles. What is a key benefit of utilizing a captive insurance company for enterprise risk management? A. It reduces the need for external reinsurance arrangements. B. It centralizes risk control and improves data-driven decision-making. C. It eliminates the financial requirements for regulatory compliance. D. It provides automatic access to broader commercial insurance markets. Answer: B. It centralizes risk control and improves data-driven decision-making. Explanation: captives enable organizations to centralize their risk management functions, providing better control over risks and access to detailed data. This improves decision-making and allows for customized solutions aligned with the parent company's risk profile. Captives do not inherently eliminate regulatory compliance requirements or guarantee broader market access. Reinsurance arrangements often complement captives to manage significant exposures. Question 13. Scenario-based question. Insurance coverage and policies. Sarah manages a captive for a multinational corporation. A policyholder files a claim related to a professional liability issue. Upon reviewing the policy, Sarah discovers that the claim arises from a situation not explicitly excluded but also not clearly defined in the coverage terms. What is the most appropriate action Sarah should take? A. Deny the claim, citing ambiguity in the policy wording. B. Seek legal counsel to interpret the policy language before making a decision. C. Approve the claim immediately to avoid potential disputes. D. Revise the policy retroactively to clarify the terms. Answer: B. Seek legal counsel to interpret the policy language before making a decision. Explanation: ambiguities in policy wording can lead to disputes. Seeking legal counsel ensures that the decision aligns with both the policyholder's expectations and the captive's obligations. Denying the claim outright or approving it without analysis risks legal and financial repercussions. Retroactive revisions are not permissible and would undermine regulatory compliance. Maine law requires clear, enforceable policy terms to protect stakeholders. Question 14. Captive operations and governance. Which of the following best describes the role of a captive manager? A. Setting underwriting guidelines for the parent company's external insurers. B. Handling day-to-day operations, including compliance and reporting. C. Serving as the primary decision-maker for the captive's board of directors. D. Conducting external audits of the parent company's risk management practices. Answer: B. Handling day-to-day operations, including compliance and reporting. Explanation: captive managers oversee the operational aspects of the captive, such as maintaining regulatory compliance, preparing financial reports, and managing service providers. While they play a critical role, ultimate decision-making rests with the board of directors. External audits and underwriting guidelines for other insurers are outside their typical scope of duties. Maine law emphasizes the importance of professional management in captive operations. Question 15. Reinsurance and captives. In which situation would a fronting arrangement most likely be necessary for a captive? A. When the captive is insuring risks in a jurisdiction where it lacks a license. B. When the captive seeks to avoid actuarial reviews. C. When the captive's parent company requires protection against high-frequency claims. D. When the captive has surplus capital and seeks to reinsure external risks. Answer: A. When the captive is insuring risks in a jurisdiction where it lacks a license. Explanation: fronting involves a licensed insurer issuing policies on behalf of the captive, enabling the captive to operate in jurisdictions where it lacks a license. This approach ensures compliance with local regulations. Actuarial reviews are still required for sound operations, and fronting does not directly address capital surpluses or high-frequency claims. Main captives may use fronting arrangements for broader risk management flexibility. Question 16. Taxation and captive insurance. Which of the following would disqualify a captive from receiving favorable tax treatment under IRS guidelines? A. The captive insures unrelated risks from at least 12 policyholders. B. The captive retains all premiums without reinsurance agreements. C. The captive operates as a risk pool for several unrelated entities. D. The captive has no demonstrated risk distribution in its portfolio. Answer: D. The captive has no demonstrated risk distribution in its portfolio. Explanation: the IRS requires captives to demonstrate risk distribution to qualify as true insurance entities. A lack of risk distribution would disqualify the captive from favorable tax treatment. Insuring unrelated risks or operating a risk pool enhances risk distribution. Retaining premiums without reinsurance is not disqualifying but may impact financial stability. Main captives must balance tax efficiency with compliance. Question 17. Emerging trends in captive insurance. How are captives addressing the growing risks associated with cyber liability? A. By requiring parent companies to self-insure all cyber risks. B. By providing tailored policies with specific limits for data breaches. C. By excluding cyber risks entirely from their coverage offerings. D. By focusing solely on property and casualty risks unrelated to cyber. Answer: B. By providing tailored policies with specific limits for data breaches. Explanation: captives are increasingly offering customized cyber liability policies to address the unique risks of data breaches and cyber attacks. These policies often include limits specific to the parent company's exposure. Excluding cyber risks would limit the captive's utility, while self-insurance or focusing on unrelated risks ignores the growing demand for cyber risk solutions. Maine encourages innovation in captive coverages. Question 18. Financial management of captives. What is a primary challenge of loss forecasting for a newly formed captive? A. Lack of historical claims data specific to the insured risks. B. Limited access to external reinsurance markets. C. Excessive regulatory oversight hindering flexibility. D. Inability to charge premiums for high-risk exposures. Answer: A. Lack of historical claims data specific to the insured risks. Explanation: new captives often face difficulties in forecasting losses due to insufficient historical data. Actuarial modeling and benchmarking against industry data can mitigate this challenge. Access to reinsurance and premium flexibility are typically available with proper planning. Regulatory oversight ensures compliance rather than posing a direct operational challenge. Maine law supports the use of sound actuarial practices for new captives. Question 19. Ethical and professional standards. Which of the following is an example of the conflict of interest in captive management? A. A captive manager serving on the parent company's risk committee. B. A captive board member directly benefiting from claims paid by the captive. C. A captive manager advocating for improved regulatory compliance processes. D. A captive using external actuarial services for risk analysis. Answer: B. A captive board member directly benefiting from claims paid by the captive. Explanation: a board member benefiting from claims creates a conflict of interest that undermines the integrity of captive management. Advocating for compliance, serving on committees, or using external services aligns with professional and ethical standards. Main regulations emphasize avoiding conflicts to ensure transparent and fair captive operations. Question 20. Case studies and practical applications. What is a lesson learned from regulatory actions against non-compliant captives in Maine? A. Over-reliance on reinsurance leads to solvency concerns. B. Failure to maintain proper financial records invites regulatory penalties. C. Offering broad policies without exclusions maximizes risk mitigation. D. Maintaining excessive surplus capital results in license revocation. Answer: B. Failure to maintain proper financial records invites regulatory penalties. Explanation: maintaining accurate financial records is crucial for regulatory compliance. Captives that fail to meet reporting and record-keeping requirements risk penalties or license revocation. Reinsurance, exclusions, and surplus capital are important considerations but do not directly lead to non-compliance. Main regulators prioritize transparency and accountability in captive management. Question 21. Captive structures. Which type of captive is most suitable for an organization with multiple subsidiaries that need to pool their risks? A. Single parent captive. B. Group captive. C. Renter captive. D. Sponsored captive. Answer: B. Group captive. Explanation: group captives are designed for multiple entities, often related subsidiaries or unrelated businesses, to pool their risks and share insurance costs. Single parent captives serve a single organization. Renter captives and sponsored captives allow access to captive benefits without owning the captive itself, but they don't inherently pool risks across multiple entities. Question 22. Regulatory reporting. What financial document must a Maine-based captive submit annually to remain in compliance? A. Quarterly policyholder satisfaction surveys. B. Annual statement prepared in accordance with statutory accounting principles. C. A detailed list of all insured clients and their claims. D. Projected premium income for the next fiscal year. Answer: B. Annual statement prepared in accordance with statutory accounting principles. Explanation: Maine requires captives to submit annual financial statements that comply with statutory accounting principles (SAP) to ensure solvency and operational soundness. Other documents, such as satisfaction surveys and client lists, are not typically required under regulatory compliance. Question 23. Risk retention and captives. What is a key consideration for a captive when determining its risk retention levels? A. The desire to avoid any reinsurance agreements. B. The parent company's financial tolerance for losses. C. The captive's location and domicile tax rates. D. The age of the captive. Answer: B. The parent company's financial tolerance for losses. Explanation: a captive's risk retention level must align with the parent company's capacity to absorb losses. Reinsurance agreements and domicile tax rates may influence operations but are not the primary factors. The captive's age is irrelevant to retention levels, which depend on risk appetite and financial strength. Question 24. Scenario-based question. Claims management. A Maine-based captive receives a claim from one of its insured entities. The claim involves damage caused by a product defect. The initial estimate suggests the claim will exceed the captive's self-insured retentions but fall within the reinsurance coverage limits. What should the captive do first? A. Deny the claim until a final cost is confirmed. B. Notify the reinsurer about the potential involvement of reinsurance coverage. C. Immediately pay the claim to expedite resolution. D. Increase the SIR to avoid activating the reinsurance. Answer: B. Notify the reinsurer about the potential involvement of reinsurance coverage. Explanation: reinsurers must be notified promptly when a claim may exceed the retention threshold. Delays can lead to disputes or denials of coverage. Paying the claim prematurely or adjusting the SIR after the fact would breach compliance or contractual obligations. Question 25. Investment strategies for captives. What investment strategy is most appropriate for a captive insurance company? A. High-risk investments to maximize potential returns. B. Low-risk investments to ensure liquidity for claims. C. Diversification into international equity markets. D. Exclusive investment in real estate holdings. Answer: B. Low-risk investments to ensure liquidity for claims. Explanation. Captives prioritize liquidity and stability to ensure funds are available to pay claims. High-risk or overly specialized investments could jeopardize financial stability. Maine regulations often encourage a prudent investment approach that supports the captive's obligations. Question 26. Emerging risks. What emerging risk has led many captives to expand their coverage offerings in recent years? A. Climate change and weather-related events. B. Currency exchange rate fluctuations. C. Reductions in corporate tax rates. D. Decline in traditional reinsurance market capacity. Answer A. Climate change and weather-related events. Explanation. Captives are increasingly providing coverage for risks related to climate change, such as floods, hurricanes, and wildfires. This reflects the growing importance of addressing environmental risks in global business operations. Other factors like tax rates or reinsurance market shifts influence strategy but are not emerging risks themselves. Question 27. Tax compliance. Which federal tax rule is particularly relevant to captives in demonstrating their insurance status? A. The safe harbor provision of Section 831. B. The risk shifting and risk distribution principles. C. The allowance for deferred premium payments. D. The exclusion of unrelated business income. Answer. B. The risk shifting and risk distribution principles. Explanation. The IRS requires captives to demonstrate risk shifting, transfer of risk to the captive, and risk distribution, pooling of risk among multiple parties, to qualify as insurance companies for tax purposes. Section 831(b) provides tax benefits but applies to small captives, not insurance status. Question 28. Operational challenges. What is a common operational challenge for small captives? A. Limited access to professional captive management services. B. High cost of regulatory compliance in domiciles like Maine. C. Lack of reinsurance options for small captives. D. Difficulty in distributing risk effectively. Answer. D. Difficulty in distributing risk effectively. Explanation. Small captives often struggle to achieve sufficient risk distribution, which is necessary for compliance and favorable tax treatment. Access to professional services and reinsurance may also pose challenges, but these are often addressed through partnerships. Question 29. Ethical considerations. What ethical concern can arise in the operation of captives? A. Using premiums exclusively for claim payments. B. Captives underpricing policies for the parent company. C. Including unrelated risks in the captive's portfolio. D. Investing in securities from the parent company. Answer. D. Investing in securities from the parent company. Explanation. Investing in the parent company's securities can lead to conflicts of interest and undermine the captive's independence. Underpricing policies may impact financial stability but is less of an ethical issue. Including unrelated risks helps achieve compliance through risk distribution. Question 30. Policy design. What feature is essential in a captive's insurance policy? A. High deductibles to reduce claims frequency. B. Clear exclusions to minimize disputes over coverage. C. Automatic renewal clauses for continuity. D. Minimal policyholder reporting requirements. Answer. B. Clear exclusions to minimize disputes over coverage. Explanation. Clear exclusions ensure that policyholders understand the scope of coverage, reducing disputes. High deductibles or automatic renewals may align with specific strategies, but are not universally essential. Transparency is a priority in Maine's regulatory framework.